Good evening, everyone. Welcome to our webinar titled Surviving and Thriving in Retirement. This is part of our Many Matters series here at the Champaign Public Library. I'm Eva Liu, reference librarian here at the Champaign Public Library. Thank you all for joining us tonight. We are currently fully open to the public with regular hours. If you are not comfortable coming to the building, we are operating our phone and virtual reference, as well as curbside pickup for any items you would like to check out at the library. For more details on this and all of the latest library news and updates, please visit us at champaign.org, or you could follow us on social media, chat with us, or you could email us at librarian@champaign.org. I would like to introduce our presenter for this evening, John Savarino. He is an investment advisor from Root Investment. John has several years of experience in financial services industry, including times in Atlanta, Georgia. Thanks for coming tonight, John. And he is going to share his expertise on financial wealth management and tax planning with us. With that, John, I'm going to turn this to you.
Thank you so much. It's a pleasure to be here with everyone here this evening. Really, my number one goal over the next 45 minutes to an hour at most is really going to be just to provide everyone here in attendance as much value as I can in that short window of time. At our firm, Rooted Wealth Advisors, we have the pleasure of serving folks, couples and individuals that are, nearing retirement or in retirement. And what I've found is that, many of them are just really overwhelmed with all the different decisions that not only are there left to make, but just all the different, financial pieces to their puzzle that they're left to fit together. And let me share my screen here as we get things started. So as Eva said, my name is John Savarino. I'm an investment advisor with the Rooted Wealth Advisors team. I have several years of experience in the industry. My focus down in Atlanta was primarily tax and estate planning, with also a focus on wealth management. As we lead into things this evening, I want to talk about a client couple that we actually brought on board right before COVID hit. And when I mean right before COVID hit, it was actually February of 2020. We had done a workshop in person at that time. We know these clients in our offices at Johnson's, Mark and Patty. And Patty, she had recently retired that December of 19 from her nursing career, where she had worked for a multitude of companies and hospitals. And she had 403Bs scattered all over the place. And anyone here watching this evening that has a 403B of their own, there's a 401A that goes with it, the employer matched. I think all in all, she had 8 403Bs and 8 401As. So she had 16 of them, kind of just still scattered all over the place. Her biggest concern was, what do I do with it? She also had 2 small pensions that she was left to make elections for. And, maybe anyone here that's done any type of election paperwork, that paperwork alone can be just such an overwhelming task. And, Mark, on the other hand, he was getting ready to retire in a couple of years. He's actually going to retire at the end of this year. He had worked for the same company for about 20 some years. He had contributed to their 401k. And his biggest concerns were Social Security. All of his friends were telling him and Patty, like, hey, take Social Security right away. The longer you prolong it, you're just leaving money on the table. But if I told everyone watching here this evening, like I told Mark and Patty, there's actually 567 different ways that one can take Social Security election benefits, 567 different ways. So of course that changed Mark and Patty's perspective. And if anyone here has the same perspective as Mark and Patty's friends, I hope that would change yours as well. And then just in regards to taxes, right? They didn't feel really in control of their taxation. So how can we make that better? And you're probably wondering, what the heck's this slide doing? But unbeknownst to me, when Mark and Patty first came into our office, I like to relate their financial situation to a junk drawer, right? They kind of had this hodgepodge of accounts, Patty's 403Bs everywhere, and they just really wasn't sure how to be efficient with that. They weren't sure on how to organize their retirement. So with that being said, tonight We're blessed to have a relationship with the Champaign Public Library and to be here tonight. Everyone that's watching knows that this is complimentary, through our relationship with the public library. But we're also, at the end of the presentation, which I'll explain further, we're going to offer our rooted retirement process, which is proprietary to our firm, where we just develop an income plan, talk about risk and some tax efficiencies, along with some estate planning ideas as well, if applicable. So kind of let the cat out of the bag. Tonight, we're primarily going to break it down into 3 segments, with the first segment being income, second is going to be risk, and then lastly, we're going to talk about taxes, right? I think taxes have been a really hot topic, over the last year and a half, and, some folks like Mark and Patty don't feel as in control of their taxes as one would like. So really, there could be some ways that we can shift some dollars around or change some contributions if we're still working. That not only is going to stretch our money further, but really increase our bottom dollar in a positive way. So I'm going to lead tonight with income, because frankly, income is the outcome we want in retirement, right? We've worked for all these years and saved all these dollars to generate this income for the lifestyle that we want to have in retirement. And maybe some of you here watching have heard of someone called Zig Ziglar. Zach Gray, he's the founder of our firm. He had introduced me to Zig Ziglar a long time ago as my mentor, and I really liked a lot of the things that Zig said. And one of the sayings that Zig Ziglar said or had was, if we kind of gathered the world's best archer and we put him in this room here today, and at the opposite end of the room, we put a target. Now, chances are he's the world's best archer, right? So he can pull an arrow out of his quiver. He's going to shoot that arrow and he's going to hit the target, right? Well, chances are, since he's the world's best archer, he's going to pull out another arrow from his quiver and he can split, the arrow that's already in the bullseye. Now, let's say that we, put a blindfold on the world's best archer. We spun him around a few times. Well, if anyone else was in this room with Kayla and I'd say duck or run for the exits, because chances are, even though he's the world's greatest archer, he is not going to come anywhere close to not only the bullseye, but the target itself. And I use that analogy for income because, once again, maybe we've done this really incredible job of saving into our different retirement portfolios. But once again, it's just kind of this hodgepodge of different things. And maybe you're thinking to yourself, well, it looks like I saved a lot of money, but, I'm just going to pull from here on the good years, and then I'm going to pull from here on some other years and just kind of, grab income when I need it. But, obviously that is not even close to being the most efficient way to draw income. And really the best way to understand how you're going to draw income in retirement is having a written retirement income plan. And we do income plans here in our office for folks that come through. It kind of looks like this. There's a few things that an income plan needs to have, because I've seen a lot of spreadsheets come across my desk through folks that come into our office, and those spreadsheets look amazing. Don't get me wrong, I'm a spreadsheet guy myself. I love spreadsheets, but there's a few things that these spreadsheets don't have, or maybe even if you have an income plan already, I assume going into retirement or in retirement, maybe there's a few things that it's not really stating, right? And I think the first thing, it's going to sound so simple, but is it easy to understand? And by taking that a step further, does your spouse understand it? Because I've had folks come into our office, once again, a couple that's come into our office, and while maybe it's the husband or the wife, they understand that spreadsheet or their income plan that they've put together, but what happens if they pass away, right? What happens if we become a widow? And I don't mean to sound morbid by that, but would your spouse understand the income plan that you've developed and put together for all these years? Chances are they're not going to. So just making sure that the income plan that you've put together is easy to understand is really important, but also make sure your spouse is involved in that. And that she or he understand it just as much as you do, just in case something happens. Does it go over different scenarios? And what I mean by that is, usually when the spreadsheets come across our desk, we're applying kind of this consistent rate of return, and whether that's 3%, 5%, 7%, and anyone here that can get me a guaranteed 7% rate of return, I'm coming with you. But we have to be prepared for different scenarios, right? We're not always going to get a consistent return in the market. So are we prepared for any type of sequence of returns risk, which we're going to touch on later in today's webinar? Can we be more tax efficient, right? Even if we look at things doing them just as we've been for our lifetime and into retirement, but what happens if we tweak a few things and we become more tax efficient? So for example, in a current scenario, I'll show you, because I think what's also important in an income plan is probability of success, right? Will I run out of money? 9 times out of 10, that's one of the biggest concerns of folks that come into our office is, John, I just want to make sure that we don't run out of money, that we've saved enough to support this lifestyle, that we want to live in retirement. And I think it's important to just to visualize what does that lifestyle, what does retirement look like for you? And to some that might sound cheesy, but I think it's really important, and then we can build around that lifestyle. But going back to the income plan, you'll see here that just lining it out year by year in terms of where's my income coming from, what does that look like from a net perspective, and what do I want to spend, right? And if there's a shortfall, then of course we have to take that shortfall from our retirement portfolio, but then when are we going to run out of money? And if we be more tax efficient, will that stretch it significantly further? I've found the majority of the time for clients, if we can be more tax efficient, which once again, we're going to talk about taxes at the latter part of this webinar, is it will stretch our money significantly further, on average 5 to 7 years. And if our money's already stretching, it will impact our bottom dollar, sometimes by tens of thousands of dollars, even hundreds of thousands of dollars. And that's really an incredible impact when you think of the legacy, that you want to leave to your kids or your grandkids, because not doing any type of tax planning, a lot of that's going to be taxable money, to your children or grandkids. If we can, shift some things around and become more tax efficient, then a lot of, that inheritance would thus be tax free. So next, I think it's important to really just break down kind of the sources of income, right? So normally I like to draw this up there, but I figured this would make things a lot clearer for everyone. And really in the past, and maybe for some of you watching today, we like to think of income and retirement specifically as this 3-legged stool. So you'll see kind of that far left leg being a pension, that middle leg being Social Security, and then the far right leg being our personal savings. And what we found is that, pensions are becoming far and far less common in the Champaign area, with U of I, of course. We still work with a lot of clients that have pensions or expect some type of service pension, which I think is an incredible source of fixed income. But companies every single year are beginning to kind of get rid of this pension benefit or this defined contribution plan for their employees. Then of course there's some concerns with Social Security. If you don't have any concerns with Social Security, I think you should have a little bit of a concern with Social Security. I'm not here to say that Social Security is going to go away from us in our lifetimes, but anyone that's looked at their Social Security statement, and if you don't know how to get your Social Security statement, you can get one for free from the Social Security Administration website. That would be ssa.gov. And from there, you can actually request a PDF copy or even an HTML copy of your Social Security statement. And once you get it, flip to page 2. And on page 2 of your Social Security statement, you'll see that if no changes, and the last time that any changes have been made to the Social Security Trust Fund was back in the late 70s, early 80s. So they're saying if no changes are made by 2035, there is only enough funds in that trust fund to pay out 78% of Social Security benefits. So once again, I'm not saying that Social Security is going to go away from us. What I also am saying is that you don't have to take my word for it. There should be some concerns about the longevity and health of Social Security, or at least how much can I expect from Social Security, because they are telling you in black and white that they can only pay out in 2035, barring no changes are made, 78% of those benefits or that benefit amount. So whatever they say you would get at full retirement age, take 22% off the top. And based on what they're telling us, that's what you can expect. So once again, there is these concerns with Social Security, or at least there should be, which leaves just a lot of pressure on our personal savings. If you look back, 5 decades, if you look back 50 years, most folks in retirement were relying on a pension and Social Security and had very little personal savings, right? They worked for all those years for those fixed income in retirement. And now it's kind of trending the opposite way, where really we're going to rely on our personal savings. And, honestly, everyone has a lifestyle that they want to live in retirement. And I think that's important. I always ask this question is, do you want to take a pay cut in retirement? And the large majority of folks that I speak to say, well, no, of course not. We might even be spending a little bit more in retirement. We want to travel. We want to spoil our grandkids, whatever the case may be. We actually find that some folks are actually going to spend a little bit more. So knowing that kind of a little bit more pressure on that personal savings leg of the stool, I also think this chart is applicable as well. So you'll see this is from 2014 to 2019. In 2014, 37% of retirees at that point in time were relying on a pension as income in retirement. 62% were relying on their personal assets. So it's a 401k, savings, whatever that might be. But 84% of retirees were relying on Social Security. So now if we look towards the right in 2019, the same percentage of retirees are utilizing Social Security in retirement. That doesn't mean that the same amount of people are utilizing Social Security in retirement. More and more people are utilizing Social Security in retirement. There is more people retiring today than we've ever seen in this country's history. There is more people retiring, which just kind of leans more pressure, on Social Security's trust fund. And, I'll be anxious to see as the years go by what kind of changes they make, or what kind of projections they alter from kind of the 78% number in 2035. You'll see pensions are becoming far and far less common, actually a 6% number. So that's just north of 1% decrease each year in pensions. And, while I think the CSRS pension is an incredible pension system, so this isn't in regards to that, but just pension as a whole, right? So a defined contribution plan, you are contributing along with your employer for kind of this income that you would get via a pension. Well, not to throw my father under the bus, but my father's been retired for 5 years, and he's blessed with 2 pensions himself. And one of those pensions, within the first year of retirement, he got a letter from that pension fund, and it said bluntly, your pension benefit is being reduced by 40%. And that's no joke. So one of his pensions within the first year of his retirement, that benefit was reduced by 40% just because that fund itself was mismanaged. So maybe even, that pension that we've expected for 15, 20, 30 years just might not be what it seemed. And then you'll see that more and more folks are relying on their personal assets in retirement. Now, as we flip to this next slide, I'm sure many of you are wondering what the heck is like this 90s sports car and a golf cart doing on the screen. I'll give you a little backstory to that. My father, that I said he's retired. He loves cars and he restores cars and just does a lot of things with vehicles. And a couple months ago, he had this 1957 Chevy in his shop that he was restoring for a friend. And back in the day, they used to have a build sheet in the glove box of these cars. And a build sheet would be very similar to if you're going to the car lot and you see a window sticker in the window. A build sheet is the window sticker of 2021. And when I saw the build sheet, I'm like, man, this is so cool, from 1957. And it showed that this 1957 Chevy, brand new in 1957, I believe it was like $2,800 is what it cost brand new. And on the flip side, my dad and I, we share this passion for drag racing. So we travel across the Midwest and participate in these higher profile events. We each have a dragster that we race. And at these racetracks, everyone has a pit vehicle. And I would say 95% of those pit vehicles are a golf cart. And we have a golf cart of our own. It's very old, I would say. Like, this thing's got to be from the 80s. But my dad, has always instilled in me, and his father, my grandfather, instilled in him, is that new's not always best, which I tend to agree with. But I thought to myself, I'm like, man, how cool would it be if I bought the old man a new golf cart? And selfishly, I would get to use it too at the racetrack. So up in Kankakee, Illinois, I have a friend, Brian Stevenson, who sells golf carts. So I called Brian up and I said, hey, Brian, how much would a brand new golf cart cost me with a few bells and whistles? And boy, I wish I would have been sitting down when Brian told me that it was going to cost me $10,000. And I said, Brian, I said, come on, I've known you for 20 years. Where's the friend price here? He says, John, that is the friend price. And, long story short, we didn't get the new golf cart. But my question is why does a golf cart, and let me repeat myself, a golf cart cost over 3 times more than a brand new vehicle in 1957? And I'm sure many of you are telling yourselves, well, I know the answer, and it's because of inflation, right? And inflation has been a really hot topic, specifically in the last 2 months, kind of in the media from an investment and finance perspective. And I think it should be. If we look at, kind of where inflation is at today, this was published in July. That number is closer to 6% as of this month. Sure, many of you, if you are drawing Social Security, saw that you're going to get a nice 5.9% cost of living adjustment on your Social Security benefits. But the reason why you're getting that cost of living adjustment is because the cost of living, because of inflation, is increased by almost 6% so far this year. And even if we look back at over a century's worth of data there at the bottom here, you'll see that, on average, we're just under 3.25. In the last decade, we've been very spoiled with this 1.7% number. And I talk about inflation because if we look back at an income plan, right? And if you already have an income plan, I assume, does your income plan also, take into account inflation, right? Or if you have a pension, is that pension keeping pace with inflation? Is it keeping pace with the cost of living? Take it a step further, right? If your personal savings, if you're having to draw income from your personal savings, are you keeping up with inflation? Are you keeping up with the cost of living? I can't stress that enough, that inflation's here, right? And I'm not here to fearmonger. Our Fed chairman, Jerome Powell, he says it's transitory, which transitory is just a fancy word for temporary. A lot of leading economists, they don't agree with that. And I tend not to agree with that either. I think it's here to stay, and at least for a little bit. So we just need to make sure that our income is prepared to keep up with inflation so we can continue to, live this lifestyle in retirement that we want. And, once again, through our partnership with the library, we're more than happy to run, these income plans, keep taking inflation into account, rates of return, things of that nature, for you. And I'll explain further here at the conclusion of tonight's presentation. So I think, as we lead into risk, which I also believe kind of to be a massive component to our retirement, really one of those risks is inflation risk, right? And an inflation risk literally means what I just hammered home, the point of making sure our income is keeping up with the cost of living, but also just in regards to investment risk, right? As maybe we've done a really incredible job over the last 30 to 40 years, and maybe we've ridden through the late 80s and then the turn of the century, 08, even COVID, it all happened so fast, and we've ridden through all those ebbs and flows. And historically, the market's going to average you about an 8% rate of return. And you've seen you said, what, I stuck the course, or maybe I made a few changes, but I came out on top each time. So I just trust the market. And I think that's great to trust the market. But if you're not having a clear understanding of how much risk your investments are, or how risky your investments are, well, in my opinion, in our firm's opinion, is you're really just rolling the dice. And if we break down risk, I think time horizon is really important. But sometimes in the short term, right, if we're looking at the short term, specifically our retirement years, or a few years here and there, consistent returns, less volatility of our portfolio, like the late 80s brought, 08, turn of the century, things of that nature, will actually yield you higher returns. Now, normally I do a kind of an example in terms of why consistent returns are important. But all I'm trying to say, if you can manage that volatility, and even if I average the same rate of return as someone that got me 30%, lost 20, got me 30, and then the other folks got me 20, but only lost me 10, and then got me 20, and we average this 5% rate of return, you will yield a higher dollar figure. So let's look at the history of the S&P. If someone tells you that they can time the market with certainty, turn around and run the other way. One thing that, no one can really time the market, and I don't suggest trying to time the market. It just leaves a lot of opportunity costs. But one thing that we do know about the market, right? One thing that I can, with certainty tell you about the market itself is that it's cyclical, right? And what I mean by cyclical is it goes up and down, right? And, historically, once again, we've averaged this 8% rate of return, specifically in the S&P 500. And what the S&P 500 is it's just a major index. It's a major index of 500 companies that is primarily used to track the performance of the market. So this is a 20-year history of the S&P 500 all the way up until September of this year. And you'll see there, back in 2001, 2002, that was towards the turn of the century where, a lot of folks really got crushed. And I'm going to explain what that means here in one more slide. But if you just follow that chart, all the way up to into September this year, you'll see a 280% total return. So if I put $100,000 in the market back at, right before 2002, that 100,000 would be $279,000. But if you split that chart in half, where has the majority of that 280% came from? It's came from the last 10 to 12 years. And the average bull run in the market, and what I mean by bull run is consistent growth. So just a consistent growth number in the market, we just see consistent positive returns, is roughly 5 years. And knowing that we're on about almost a 12-year bull run, that just tells me that there is at least some type of cooling off, coming, or at least some type of correction. And that's, once again, not to fearmonger. I don't know when that's going to be. But I always ask this question is, who here thinks that the next 6 to 8 months, we're going to see the same incredible growth that we've seen since April of 2020? And sometimes I get a few hands here and there, but quite frankly, we're not. Now, I think, is my opinion, is that the next 6 to 8 months, we should see some positive returns, barring any type of negative catalyst in the market. And the reason for that is if anyone here has heard of this "don't fight the Fed" mentality, is that we've just done so much spending to crush this market up that spending is going to continue to come to fruition over the next at least half a year. My concern comes 12 to 18 months as some different economic policies kind of come into place, tax reform being talked about, and really just the Fed talking about tapering their assets, really to stop kind of stimulating the economy, which could kind of bring things to a halt. Like, once again, I'm not saying the market's going to drop out completely, but a correction or some type of cooling off would actually be healthy. And when I tell you that the average bear market, which bear market's just going to be kind of this consistent downward trend, is roughly 2 years, 5 years for a bull run, 2 years for a bear run. And we've been on this bull run for 12 years. And we see all these different catalysts kind of just brewing, in our economy, internationally, in the markets itself from a fundamental perspective. So once again, not to belabor this point, but I think just at least understanding how much risk you're taking and how that could affect your retirement is super important. One thing that we run for folks that come through our retirement process is we talk about risk. So you'll see we have this number here and then just some data here. What that number tells you is really just from a high level, how much risk am I taking? It's on a scale of 1 to 100. 1 is going to be cash under my mattress, where I'm just very conservative and I can't lose any type of money. It's not at risk. And 100 is going to say, Kayla and I, we go to Vegas and we put it all on black. It's going to be as risky as it gets. So what this number tells us is, in comparison to the market, how much risk are we taking? And at that point, we can draw some predictions, right, of what's going to happen. This software was actually developed by a Nobel Prize laureate. It just takes very complex standard deviation, beta and alpha data, and kind of gives us that number as a baseline of maybe we're not taking enough risk, right? Because I think it's important to keep up with inflation once again, or at least having a few pieces of our portfolio that's going to keep up. Or are we just taking way too much risk going into retirement? Either or. I think it's important to, at the very least, just understand how much risk you're taking. I plead with you, especially as we go into the next 12 to 18 months. And I mentioned sequence of returns risk earlier, and I kind of want to elaborate on what sequence of return risk means. And really, it just depends on, when do we need money from our retirement portfolios and how the market's doing. So Steve and Bill, in this scenario, as you can see on the screen, they look like brothers, so I'm going to call them brothers. Everything about Steve and Bill is the exact same, except they retire at a different time. So you'll see Steve retires in 1990. Bill, you might not be able to see it, but he's going to retire in 2000. And they both are going to start with a $500,000 IRA account balance. They both need $30,000 a year in retirement to supplement this lifestyle. So they're going to draw $30,000 from the retirement portfolio, and they're both taking the risk of the market, which is risky, right? Especially going into retirement. And I just want to show you how sequence of returns risk can be a gamble going into retirement. So you'll see Steve at the end of 1990, he gets a small loss at that year, but he's still got about $450,000 after his $30,000 draw. And just to clarify, this market return is actual returns of the Dow Jones for these years. And Bill, as you can see in 2000, he gets a small loss as well, needs his 30,000. He has close to 450,000 as well. But back to Steve's situation or his scenario, anyone that remembers the 90s remembers that the 90s were really one of the best decades in market history. If you would have put $100,000 in the market in 1990, fell asleep, woke up 10 years later, that $100,000 would have sextupled. You would now have $600,000 in your portfolio. So you'll see Steve's able to take advantage of this incredible decade, takes out $300,000 over 10 years and has over $1.2 million in his IRA. Steve is feeling really good about his retirement. Bill, on the other hand, everything's the same. He just retires at the turn of the century instead of 1990 like his brother Steve. Anyone that remembers the turn of the century knows kind of this tech bust is what some folks call it. He has 3 consistent downward years, has 1 good year in 2003, has kind of some flat years with 2006 being decent. And the majority of folks watching, here this evening knows what happened in 2008. And you can see how things play out. After 10 years, Bill needs his $30,000 draw, just like Steve did, but he's left with only $156,000 in his IRA account portfolio. He's not going to make it. Okay. He has drawn that down so much because of sequence of return risk that he's just not going to make it in retirement, or he's not going to be able to live, the same lifestyle with that $30,000 draw. So once again, I plead with you, if you don't at the very least understand how much risk you're taking and how risk or how sequence of return risk like this scenario could affect you and your income in retirement, then please just understand it and just protect yourself at the very least. Performance is super important. We want our money to grow, but just at least having, a well-diversified portfolio to prevent a bill situation is super important. So tonight we're going to finish with taxes, right? And taxes is one of the hottest topics really in our country right now. Even last year, this time last year, the media was kind of just all over taxes and, tax proposals and some different tax reform. I always ask this question for folks in person is, how many here think that taxes are going to go up in the future? And maybe I would assume for every participant here this evening, they think taxes are going to go up in the future. And I tend to agree with that. If you're not doing any type of tax planning, if tax planning is not a part of your financial plan or your retirement plan, it is literally like flushing money down the drain. Because at our firm, Rooted Wealth Advisors, it's a lot more than just this grandiose investment philosophy, right? I think investments are, of course, incredibly important, but what's just as important is taxes, right? And tax planning, because by being strategic with tax planning, it thus keeps more money in our pockets, right? And everyone wants to keep more money in our pockets, or at least away from Uncle Sam for the most part. So making sure, a tax plan is a part of your retirement plan is super important. And once again, if we can be more tax efficient, right? If we can be more tax efficient, it will, and I assure you, for 90% of folks, it will stretch your money significantly further. And I'll explain from a high level, what I mean by that. So if you think of our retirement portfolios, right? So if everyone here watching, if we took everyone's retirement portfolios, if we took mine, we took Kayla's, and we just kind of gathered them up here at the center of my table or my desk here, they're going to be broken down in 1 of 3 categories, income-wise, from those portfolios. Every single one from an income perspective is going to fall in 1 of the 3 buckets. Zach and I, we actually wrote a book, the Retirement Roadmap, that's based strictly around taxes and retirement and these 3 buckets. If anyone is interested in getting a free copy of that book, then just please reach out to Terry or Kayla in our office, or Eva, and she'll connect you, and we'll make sure to get you a free copy of that book. But what do these buckets mean to everyone watching, right? Well, let's start with that far left bucket, the taxable bucket, as I like to call it, a 1099 bucket. And I'll explain what that means. So if you have just some bank money, right? If you have some savings or even a CD, if you still have one, you earn a little bit of interest throughout the year. At the beginning of the next calendar year, you get a 1099. They say, hey, you owe a little bit of tax on the interest. Now, obviously, I know our savings and CDs are not paying much, but no matter what you earn, you got to pay a little tax on the interest. But maybe you have like an individual account, a TOD, a transfer on death account, maybe a joint non-qualified account, even like a trust, that if you have some investments in your trust, they are all going to fall under that taxable bucket. In regards to maybe you get some dividends that are paid into those accounts. You get a 1099 that says, hey, you owe a little bit of tax on those dividends. If you realize some gains on those accounts, which if I bought ABC at 20 and I sold it at 40, if I sold it at 40 and realized that gain of 20, I'm going to owe a little bit of tax. If I have a pension, that pension is going to flow right through that taxable bucket. And then when we think of tax deferred money, that middle bucket there, I like to think of the D as kind of the deduction that we get. So any money that I contribute to this bucket or an account that falls underneath that bucket, I get to deduct it on my taxes for that calendar year. So maybe you have a traditional 401k that you're currently contributing to through your workplace or your employer that would fall under tax deferred money. I get to deduct the taxes in that calendar year, whatever amount that I put into this bucket or that 401k, it grows tax deferred. And then when I go to take a distribution from that bucket, I'm then, stuck paying my highest ordinary income tax rate on those distributions. And if I have a traditional IRA, it's going to fall underneath that bucket. Maybe I have a 403B or a 457. Those are all going to fall under this tax deferred bucket. And I think the kicker is maybe some folks are already at that age, is you are eventually going to be required to take money out of this bucket. And I always think it's interesting for folks that have maybe a good pension and Social Security that are just continuously saving into this bucket, knowing that they're going to be in the same tax bracket, eventually you're going to be forced to take money. It's via a RMD, also known as a required minimum distribution, that starts at age 72. Which just says even if you don't need any money from that 401k or that IRA, they are going to force you to take it out. And the RMD amount is based on some actuarial tables that you can find on irs.gov. But from a percentage standpoint, if you're 72 this year, that percentage is about 3.6 to 3.7% of your entire tax deferred portfolio. And that number just continuously, or that percentage just continuously increases as the years go on. And then this last bucket is going to be tax-free, any type of Roth money. So maybe you have a Roth 401k or a Roth 403b through your employer. Maybe you have a Roth IRA. There is some life insurance that if properly structured can produce some tax-free income. But how I think of that bucket is I pay tax from my paycheck or my earned income. And then with that money that I've already paid tax on, I'm then able to contribute it to this bucket. It grows tax-free. I'm able to take distributions from it tax-free. Even if my kids or my grandkids inherit money from that bucket, it's tax-free. So really, you pay tax on kind of the seed that you're planting, just to take advantage of tax-free growth and tax-free distributions. And I asked this question at the beginning of kind of our tax segment, and in terms of anyone here think that taxes are going to go up in the future, I'm here to tell you that barring any tax law changes, they are going to go up in the future. So back at the end of 2016, for 2017, the Tax Cuts and Jobs Act was passed. And what that did is it lowered most of our marginal tax brackets. And what I mean by that is, I don't have any. So if you think of it like a graduated cylinder, think of kind of that bottom portion. Anything that fills up that bottom portion today would be taxed at a 10% rate. And then anything above 10% is going to be taxed at 12%. Anything above 12% from an income perspective is going to be taxed at 22. Anything above that is going to be 24. And thus you get some type of effective tax rate. But what they were before and what is set to expire, the sunset provision is going to expire December 31st, 2025, is those rates are now going to go back up what they were prior to 2017. And 10 is going to stay at 10. There is like this plus 1% kind of provision in there based on inflation, which may happen, but let's just stick with what we know. 10 is going to stay at 10. 12 is going to go to 15. 22 is going to go back to 25. 24 today is going to go back to 28, 32 is going to go back to 33, and so forth. So I asked this question is, is 24 less than 25? Of course, 24 is less than 25. And if you're going to tell me that you don't want to take a pay cut in retirement, or you're not going to take a pay cut in retirement, we're deferring, we're deducting 22 cents on our dollars by contributing to this tax deferred bucket just to possibly pay 25, 28%, on those dollars in retirement. And the only thing I'll say, as we kind of wrap things up, is provisional income. If no one here has ever heard of provisional income is a calculation that tells you how much of your Social Security will become taxable. And if anyone has maybe a pen or paper on hand, and it's something that we can walk you through, through our retirement process. But if you have a pen and paper on hand, it's going to be any income from bucket one. So if I have a pension, make sure you include all that pension income, any type of interest or dividend income or realized gains, all going to be included in this calculation. Any distributions from that tax deferred bucket, including RMDs, will be considered. And then take half of your household Social Security. So what I mean by that is if I get 20,000 of Social Security, my wife gets 10,000, we're going to factor in $15,000 into this equation. And depending on where that, equation, that calculation ends up at, for a married couple, if it ends up between $0 and $32,000, then none of your Social Security becomes taxable income. You get to keep it all. If that falls between 32 and 44,000, 50% of our Social Security becomes taxable income. It is factored in as taxable income for that calendar year, and you pay your highest ordinary income tax rate on those dollars. And then anything for a married couple above $44,000, 85% of your Social Security becomes taxable income at your highest ordinary income tax rate. For all of our single taxpayer viewers, those numbers would be between 0 and 25,000. None of it becomes taxable. 25 and 34,000 becomes 50% of it becomes taxable. And anything above 34,000, 85% of it becomes taxable income. So really, once we can understand where our money falls today, right? Where our money falls today, or where our portfolios fall, if we can kind of manipulate these tax buckets, utilizing tax code today, really we can start making some shifts from kind of this taxable bucket that we're taxed every single year on this money. We are taxed in perpetuity on any money that's in that far left bucket. So if we can just work on being strategic in terms of moving some of that money from there, from tax deferred into tax free, once again, it will stretch your money further. It will impact your bottom dollar in a very, very positive impact, and it will, positively impact your estate too, the inheritance that your kids and grandkids get, in a very positive way. And quickly, if you have any money in that taxable bucket and you have some type of earned or 1099 income and you're not making a contribution to a Roth IRA, run away, slam dunk, take a portion of that taxable money and make a contribution to your Roth IRA, because once again, we're shifting dollars that are going to be taxed in perpetuity to tax-free dollars. So once again, I asked the question kind of to maybe change some of our perspectives. If we know we're not going to take a pay cut in retirement, we know we're not going to drop a bracket or multiple tax brackets in retirement, the question that I ask you is, would you rather pay tax on the seed that you plant and then never pay tax again? Or would you rather defer tax and just pay tax on the entire harvest after it grows? And hopefully that perspective can kind of change things, right? We all have this very micro view of taxation in regards to how much can I save in taxes in this calendar year, right? But we're not thinking kind of a macro view of taxation in terms of, how can I save taxes over the next 10, 15, 20 years, and how does things look? And I want to give you an example of that. So the question is how does saving tax on $155,000 of income lead to paying tax on over $1 million? Well, hopefully everyone here can see the chart You'll see on the left, it has this growth and accumulation stage. On the right, it has a protection and distribution stage. So let's just say we have someone that's age 35. They want to start saving for retirement at this point. So they're going to contribute $5,000 into a traditional IRA, a tax deferred account. So every $5,000 that they put in per year, they're able to deduct it on their calendar or on their taxes for that calendar year, defer the growth just to pay it on the distributions when it comes out. And we're going to apply a fixed rate of return of 7% to this IRA for this person. And you'll see that he's going to, over the next 31 years, up until the end of age 65, he's going to contribute a total of $155,000. So he has deferred taxes on $155,000 of income. And of course, with that 7% rate of return compounding over 31 years, he or she now has north of $500,000. I'm not sure if you can see this, but you'll see now he or she wants to retire starting at age 66. They have a pension. They have Social Security that takes care of their expenses. They don't need any of this money that they just saved for retirement. So the next 5-6 years, they don't have to take any draws. But once again, age 72 comes, you're required to take a minimum distribution from this account. You'll see that they apply a divisor for this RMD, which I like to keep things simple and think of it as a percentage, which once again, roughly 3.6, 3.7. So you'll just see, we even take the interest, the rate of return, we back it down to 5 because once again, we don't need to be taking as much risk. It's not about triples and doubles in retirement. It's about singles and doubles and consistent returns. But the RMD amount just continuously increases and increases, and he's pulling these dollars out of his portfolio. So he or she has had to withdraw almost $800,000 from that IRA portfolio. They are literally going backwards from tax deferred money to taxable money. Once again, we want our money to grow. So now we're just paying taxes on it every year. So now he's been taxing over almost $800,000 of withdrawals. There's still $584,000 left over that he or she is going to pass on to their kids, which they will have to pay their highest ordinary income tax rate over a 10-year period. They have to withdraw as a non-spouse beneficiary that amount in a 10-year period, thus leading us to pay, taxes on over $1.3 million. So we deferred taxes on 155 just to pay taxes on over $1.3 million. So once again, through our partnership that we are so blessed to have with, the Champaign Public Library, our rooted retirement process is complimentary, right? We'll put together the income plan that I discussed there at the beginning. We'll talk about risk, get you a firm, clear, and concise understanding of how much risk you're taking. And, from a quantitative perspective, does it align with your time horizon of retirement or just needing that money? But I think even if there's a qualitative factor in terms of, how much money, watching yourself lose X amount of dollars, if that makes you lose sleep at night, then we need to crank risk a little bit back. And then how can we reduce our taxes, right? How can we be more tax efficient? And how does that stretch our money further? If that is something that you're interested, of course, Eva can connect us or connect you with our firm. Or just reach out to our firm at 815-918-4727. Our Champaign office location is located at the Village. There at 3015 Village Office Place at the Warren Huddleston building. We are the first office on the right that we share with Bartell, Powell, and attorneys. And once again, there's no type of timeshare presentation. There's no cost to this. It is a part of our relationship with the public library to not only do the webinar here this evening, but to offer our retirement process to everyone here viewing tonight. With that being said, Eva, I think we can open it up for some questions.
Okay, thank you, John. That was great. As John
mentioned, you so much.
Thank you. As John mentioned, if you have any questions, feel free to type them into the chat, or you could raise your hands and we could unmute you if you prefer to ask your questions. I think we have a question here. The first question is, how much risk was Bill taking?
Thank you so much. Let me show you real quick, if you don't mind, that I go back to that slide. I might have missed that, which I certainly apologize. So Bill was taking the same amount of risk as Steve. So these market returns are the Dow Jones. So they're both taking the risk of the market, aka the Dow Jones at that time. Hopefully that answers your question. If I need to elaborate, please let me know.
I have a question here. I heard people say that when you withdraw your retirement, the first you have to withdraw money from your stock investment, then your pension, then the last one will be Roth IRA. And what is the reason behind this?
So, really when we think of orders of liquidation, right? So what's the best order to liquidate our assets or in terms of drawing income from? There's not necessarily to wait on a pension, right? Unless we retire early. So predominantly our pension is going to be kind of a primary source of income that we're relying on immediately in retirement, barring any type of age gap when you can get that pension. But when you think of kind of like a Roth IRA versus any type of tax deferred money or like your traditional 401k, we usually want to wait to draw any type of funds from our Roth IRA, because when we talk about taxes, not only do we all here think that taxes are going to go up in the future, we know that taxes are going to go up in the future. So no sense in drawing any type of tax-free income, knowing that we have all this tax deferred income to draw off of. So let's draw our tax deferred income first and wait on the Roth IRA tax-free money. Hopefully that answers the question, but I can elaborate further.
Okay. Any questions? You could type your question into the chat. John, you mentioned that you have income plan, like in a PDF file that you could share with the audience here tonight. Is that right?
In a PDF file, Kayla, do we have an income plan in a PDF file? Oh.
Maybe you could, I don't know, maybe something that if any participants today that are interested in the file, they could contact me and maybe I could get the file from you later. You could email that to me.
Yeah, we can show what like a template would look like. I can, from a high level, I'll just show everyone here what it looks like. So really, this first page is just going to give us our information. If we're still working, what our Social Security looks like. Of course, as I mentioned before, we get this cost of living adjustment in Social Security or with Social Security. So we just historically look at those tables and apply kind of an average. And then, of course, our pension is going to be taken into consideration as well. And then we go through orders of liquidation, which I think are important. What I mentioned is, what portfolios do we draw income from first or quote unquote liquidate? Rates of return, right? What kind of rates of return are we projecting for? Expenses and inflation. Once again, making sure it is so imperative that we are taking inflation into account for our income plan. And everyone's seeing it today, right? In just terms of cost of living has been increasing. So making sure that we understand kind of the time value of money. $1 today is not going to be the same tomorrow. Taxes, right? In terms of what kind of deductions, how our tax breakdown is. And then past that is really just line by line each year, right? Where's the income coming from in that year? Net wise, where's our shortfall, right? And what I mean by shortfall is how much do we need to pull from our retirement portfolios? But I'll see if Kayla can get us some type of template and email that over to you. I do see there's another couple questions, if you don't mind me answering those, Eva.
Sure.
So how do you decide what risk is right for you? Once again, there's a quantitative factor that just says based on our time horizon, right? Time horizon of our funds, how much risk should we be taking? And that's just using data and statistics. If we have, let's just say, for example, 20 to 30 years, then I'm a firm believer that long-term growth and accumulation will win that race, right? Long-term growth and accumulation with that much time on our hands is the best way to grow wealth, right? And but if we only have a year or two, right? If we have an expected expense, a big expected expense or need, then at that point we should not be taking really any risk at all. If we expect to use a certain amount of funds within a year, don't take any risk with those funds from a foundational level. 1 to 5 years, we can kind of tweak it a little bit, but really your time horizon, this is from a high level I'm speaking, should determine how much risk you're taking. But once again, I've had a lot of folks come into our office and say, well, John, I'm a conservative gal or I'm a conservative guy, and they're taking, the risk of the market, and they're just shocked by that. So once again, there's a quantitative factor that just from a high level, how long do we have before we need any of these funds? And then just this qualitative factor in regards to, will I be able to sleep at night if the market's not doing incredibly well? And then where does real estate fit in investment? I think real estate from an income perspective is really great to have as passive income. It provides us with a lot of tax advantages for anyone here that owns any type of real estate or has any familiarity with real estate. The tax advantages can really make a huge impact. But as of today, there's a lot of kind of capital gains tax ramifications that are in the crosshairs of tax reform today, which can change a lot of things. But I think real estate is an incredible piece to have in our portfolios, just from a wealth and investment perspective. But we got to get kind of the foundation built first in terms of a retirement portfolio, and then seeing how real estate fits, I think can benefit us all in a big, big way. But with real estate comes a lot of risk. So let's not don't misconstrue my words. But thank you so much. I appreciate those questions.
Okay, thank you, John, for all the helpful information in your presentation tonight. And also thank you all for your attendance tonight. A recording of this event and many of our previous library webinars will be found on Champaign Public Library's YouTube channel. Due to the holiday, this will be our last program for the year. However, this series will go on next January for the first webinar on tax planning strategies in year 2022. We hope to see you all. Thank you, everyone. Thank you.
Thank you, everyone. Appreciate it.